Good morning. So we've had a lot of conversations online on Twitter and YouTube in the comments on different channels. There's a group out there that call them the Crash Bros, saying that the housing market's going to crash. We're 40, 50% overvalued. And then there's others that are saying that the value is going to stay, that the prices aren't going to come down. It's a supply demand issue. And then there's another group that will say that, yeah, we're going to have a correction, which means it's not over 20%. That's maybe 10, 5, 10, 15% correction in pricing. So I was on the camp on correction, pushing on the edge of actual crash of almost up to 20%. So somewhere between 10 and 20%. I'm still kind of believe that, and I base that off of the incomes out there. And I know that's not what you need to correct house prices. I understand the supply demand, ratio on that. But there's another component here that I think is overlooked. I was on driving up here and I was listening to Mark Moss, and he's talking about his Bitcoin and the monetary expansion. And, he's got a lot of good information. He was also talking about the different generations. So, one of the things that kind of interested me, there's an argument out there in the late 70s, early 80s, the housing market did a similar thing, high interest rates, and house prices continued to go up. And how can that be? Well, one thing is the Fed was messing with inflation, monetary expansion. So part of that is they had a huge generation on the baby boomers, and they had to increase money supply. Is the theory behind it, or one of the theories behind it? We've got a similar deal with the millennials. Millennials are actually a bigger generation than the baby boomers. So that can explain why this monetary expansion has gone on so big. So that pricing, that expansion in the early or late 70s, early 80s, I think is going on now. I think that is probably our best model. So that's kind of moved me off of that crash into maybe a correction. But I'm starting to think that that correction is not going to come in the form of actual price drops. No, the prices are going to drop, but it's not going to be it's going to be inflation adjusted dollars. So I think some people would call that the crash up. So I'm going to try to share my screen here and share window. Here we go. Okay, can you see me now? So what we have here is we have in the red, or the blue is the M2. That's our monetary supply. That's actual cash in the system. And then the red is the Case-Shiller Home Price Index. And then the green line is our average hourly earnings of all employees. So in the early 2000s, we saw a housing bubble form. And right here, we can see that tracked on that red line. I can't hold that mouse over there, it keeps grabbing different things. But you'll see that red line here, that bubble, that housing bubble there, kind of peaked in April 2006. Yeah, I can't control that mouse. Anyhow, so it peaked in 2006, and that M2 money supply stayed relatively flat. And you can see the years going back to the mid 80s or late 80s, where those two lines ran pretty close to one another. That's all the further back this data goes. Now you can see that M2 continued to climb after the housing bubble crashed, and you can see that difference between the red line and the blue line, between the Case-Shiller index and the M2 money supply. And then once we got to COVID here in 2020, the Fed injected a ton of money into the system. That's our M2, and printed or digitized or whatever you call it into the system. And the asset price continued to follow. The house prices continued that. In fact, that spread is getting further and further apart. So if this data is true, that would say that house prices to money supply would continue to get closer. So values would continue to go up. Now, the problem that everyone's feeling right now is this hourly earnings. So if you're a income earner versus capital gains investor, you're feeling that pinch. That spread between the green and the red line is getting farther and farther apart. That's the haves and the have-nots. So I think that green line will eventually start to rise and get closer to that red line. And that red line, meaning the Case-Shiller Home Price Index, will trend closer to that M2 money supply. But I think that M2 money supply may outpace the Case-Shiller Home Price Index. So how do I explain this? If the rate of monetary expansion has been averaging 8 to 10%, that's what Mark Moss was saying in his video. And I looked it up on Y charts. I'm looking at my notes here. Y chart said 7.5% is the average growth rate on monetary expansion. That's a M2. And let's just say in my local market, the Twin Cities median home price went up by 3%. If monetary expansion is growing at 8%, that's basically a 4% decline in values, right? Or 5% decline in values. So we're actually losing that value in that spread, and that would explain that red Case-Shiller Home Price Index and the M2 money supply. Now median sales prices are skewed, right? It's there's no two houses are alike, so you're taking the average or you're taking the median, and things can make that median number skewed in many different ways. So it's hard to gauge where that's going to go. I'm looking at more the trajectory is what I'm concerned about on the house prices versus what the actual median or the average says. So are house prices going to trend up? Yes or no? Based on this theory and the monetary expansion, I would say that house prices are going to continue to climb. But they're probably not going to climb as fast as the M2 money supply climbed because it's going to be held down by wage growth. So now if you're investing, and that's kind of one of the other aspects of the housing market here, is as their M2 money supply is expanding, investors are concerned about inflation. Real estate's been a good hedge against inflation, so that spurred a lot of investment into the real estate market. So Mark Moss was talking Bitcoin return. I forget exactly what he said on the video. I didn't write it down, but I looked it up. So Bitcoin's 3-year return on the source I looked at was about 160% or 53% a year. So if you subtract that out, take another 8% off of that, what are you at? 45%, 46% return on investment. And then if you're earning in the NASDAQ, they say the 1-year return was 20%. Previous year was lower, but let's just say it's 16%. And in monetary expansions, 8%. You're only earning 8% on that money. Now, in the housing market, if you're only earning 3%, so if you took $400,000 and you bought a house hoping that goes up in value, you're going to go backwards, right? It's like saving money. Because that M2, the money is being printed faster than that home price is going up at this point. As an investor, there's different ways to calculate that because you're leveraging the debt. You're not putting the full 400% down. Let's say you're doing the 20% down, so you're putting about 80 grand down, and you're earning off of the full 400% with a 20% down investment. That changes the whole ratios. Plus, you get some tax savings on depreciation, and then you get inflation through rent increase, and then you get cash flow on top of that. So you're earning money several different ways. So our house price has gone crazy expensive, yes, but so has the money supply. And what's hurting everyone is they've injected so much money into the system that inflation has gone crazy, and you're seeing the pinch. People are being pinched. I'm seeing that with rental applications. People are maxed out on their credit cards. Their credit scores are low. People are in a tough shape. Now, the other thing I've noticed is I like to spend a lot of time up north here, and I'm looking for a boat motor. And I'm a professional shopper. I'm not a consumer. I don't buy. I just shop. So I've been looking for a used boat motor for, gosh, I don't know, 8, 10 years. Just waiting for that perfect motor for the right price. And I was seeing these little Johnson, these old 1960s 9.5 horses. They were going for maybe $600 during COVID, right when everyone was flush with cash. Those prices are back down between 250 and 350 now for that same motor. Car prices, so watching the used car prices, those are coming down as inventory is starting to build up. So it's going to be interesting to see how that money supply gets reined back in. I'm not sure how the Fed quite does that, but if you look on that chart there, you're seeing that money supply start to come back in. And there's a lot of pain with that too. So these are going to be a rough few years as we go forward. I do think that that early 80s model of the house prices is the way to go to compare it what we're in. Originally, I was thinking 10-20% correction. Now I'm starting to think that we're going to see that correction closer to that 10% range, but I think we're going to see it in inflation adjusted dollars. So it's going to appear that it's going up, but it's actually going backwards, um, which is good because we need affordable housing. We need actually more increased in incomes. Incomes have to catch up. So, and those are going to be tough adjustments as we go forward. So those are my thoughts. I'd love to hear your input on if this is solid theory, or if I'm missing a big aspect of this. I'm trying to piece a lot of different channels together on what I've been learning on those channels and apply it to my background, which is real estate and 30 years of real estate sales and investing. So that's what I got for today. I'm going to get to some chores up here and enjoy the nice weekend. So have a great weekend. We'll talk to you soon.